Welcome to Fairport Flash, the monthly economic update powered by the Fairport Investment Team. Our team gathers the most recent news, data, and research and distills it into the information most important to you. Let's get started.
Welcome to this month's Fairport Flash. This is Katie Sheehan, Portfolio Manager at Fairport Wealth. I'm primarily responsible for assisting in the development and implementation of the firm's investment strategy with a focus on equities and impact investing. Since we've just passed Valentine's Day and spring is just around the corner, or so we hope, and at the risk of seeming as though we walk around with rose-colored glasses at Fairport, we're presenting you today with the charts that we love. To remain unbiased in our assessment, there will be comment at the conclusion surrounding some of the things we don't love as much, so stick around. Separately, we understand some of you may be listening in the comfort of your driver's seat. Please do not pull up the charts while driving. It's not safe. I'll be providing a high-level overview of each chart so you can still follow along. First up, we have a chart that graphically represents the continued strength in the housing market. The NAHB Home Builders Survey remained at record levels in February, driven by demographics and low mortgage rates. Beyond just home builders, housing starts, existing sales, and refinancing continue to be a harbinger of domestic growth, helping maintain the current expansion. After 5 months of reporting contractionary readings, the U.S. ISM Manufacturing Purchasing Managers Index, it's a mouthful, so just the PMI, rose above 50 in January, indicating an expansion in factory activity and marking an improvement from the third mini downturn in manufacturing since the recession. Now, one observation from the chart is that these mini downturns are not unusual. In fact, there's generally at least one in each of the cycles presented since before 1950. Additionally, each economic recession has been accompanied by a PMI reading below 45. While one reading above 50 does not a trend make, it's encouraging to see, particularly as survey respondent sentiment was moderately positive regarding growth in the near term. Just as purchasing manager sentiment is relatively positive, consumer sentiment, as measured by the University of Michigan Index, has moved higher in recent months as well. According to the report issued, consumers view their current financial situations, home buying attitudes, and recent changes to the economy as favorable, all factors that should help extend the current cycle. There also appears to be a positive correlation in the past few decades between consumer sentiment and the S&P 500, an encouraging indicator for the equity market. Similarly, year-over-year changes in manufacturing PMI and consumer confidence tend to move in line with year-over-year changes in S&P corporate earnings per share. Now, that's not necessarily surprising given the impact each can have on corporate performance. The recent uptick in both indicators bode well for future earnings growth, which is an important underlying driver for equity returns. Now, not surprisingly, one of the unknowns currently is the coronavirus and the effect it will have not just on growth in China, but also in the U.S. and equity markets. It's certainly provided for added volatility in recent weeks, particularly with recent supply chain issues announced by behemoths like Apple, but it's expected most of the impact will be experienced in the first quarter and will likely be relatively contained to China. While the outcome is not certain, it's encouraging to see the past epidemics have tended to have little to no long-term effect on the performance of the equity market. In each case, going back to 1997, the equity market was positive 6 months out, and in every instance, except for SARS in 2002, the equity market was even positive 3 months out. So short-term noise is to be expected, but ultimately continued easing in China to offset some of the decline in growth should prove to be a benefit. And these easing financial conditions continue to push market multiples higher. The current PE multiple, which is essentially a measure of how much an investor is willing to pay for earnings, is above that of the long-term average of around 15 times. A higher than average multiple would typically imply the equity market is relatively more expensive. However, low interest rates and low levels of inflation are actually supportive of these higher multiples because it typically results in higher real earnings growth. Speaking of earnings, fourth quarter earnings season has largely wrapped up and results were better than expected. Growth estimates began the reporting season at negative 0.3%, but ended up positive 2.5%. This isn't unusual. Actual reported growth typically does end higher than initial estimates, generally by a margin of around 3 to 5%. With that, earnings estimates were revised lower for full year 2020 during the reporting season, but even with these lower estimates, S&P earnings are expected to grow around 8% this year. And last but not least, I would be remiss if I did not include a chart relating the presidential election to the S&P. You may have seen this chart before. It's definitely one of our favorites, but it is pretty telling. Essentially, history has shown that the S&P actually does a pretty good job of predicting who will win the election, so keep an eye on the market as we head closer to November. The chart also indicates that during presidential election years, the equity market has historically had positive performance whether the incumbent wins or loses. So that's it for the charts we love. As for some of the factors that are giving us pause, well, we're watching how the coronavirus impacts global growth, specifically China, and of course, any residual effect it has on the U.S. Additionally, the potential for manufacturing to resume the downtrend from the end of last year, and it would not be surprising if we experience at least one larger correction in 2020. Historically, there's at least one 10% correction in any given calendar year. So that brings us to the conclusion of our Valentine-inspired Fairport Flash. As always, our goal at Fairport Wealth is inspiring families, and as a member of the investment team, we strive to do this through a long-term diversified approach. If you'd like to discuss any of today's topics in more detail, please reach out to your Fairport advisor. Thank you for listening, and be sure to tune in next month.
Fairport is a group of investment professionals registered with Hightower Securities, LLC, a member of FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there's no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinion, news, research, analysis, prices, or other information contained in the research is provided as a general market commentary. It does not constitute as investment advice. Fairport and Hightower shall not be in any way liable for claims that make no express or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements and errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Fairport and do not represent those of Hightower Advisors, LLC, or any of its affiliates.